Welcome back, CMA candidates. I know exactly how hard you're all working right now, just grinding through that syllabus. And I want to tell you right out of the gate, you are doing a fantastic job. In today's explainer, we're going to tackle something that I see trip up even my absolute best students. We're diving deep into the tricky, nitty-gritty details of performance management. Specifically, we're going to master a concept that the CMA exam absolutely loves to test. Now, you already know the basic formula for return on investment, or ROI. It's just income divided by the investment base, right? We've already mastered this, along with residual income. But as your teacher, I have to give you a fair warning here. The devil is entirely in the details. And those details, well, they're sitting right there at the bottom of that fraction. So it begs the question, what exactly constitutes that investment base? Are we talking about what we paid for a piece of equipment, say 10 years ago? Or what it's worth today? Or maybe the original cost minus all that depreciation? We call this the denominator dilemma. And listen, if a company chooses the wrong way to value its assets, the results can be completely skewed. I'm serious, choosing the wrong valuation method can literally make a terrible, highly inefficient manager look like an absolute hero, while making a great, forward-thinking manager look like a total failure. Okay, so let's dive into this. We're going to conquer the 4 pillars of the investment base today, so you can dodge every single trap the CMA exam tries to set. We'll hit valuation, looking at gross versus net, then measurement, comparing historical to current. After that, we'll cover asset inclusion rules, and finally, timing, comparing average to year end. Let's get right to it. Starting off with our first pillar, valuation, specifically gross versus net book value. This is arguably the most common investment-based topic you're going to face on the exam, so definitely pay close attention here. Let's break down how this works. On one side, we have gross book value, or GBV. This is just the original cost of the asset. The really big pro of using gross book value is that it doesn't change over time. It keeps a manager's ROI perfectly stable, meaning it's not going to wildly fluctuate just because a piece of equipment is getting a little older. But on the other side, we have net book value, or NBV. This is that original cost minus accumulated depreciation. Now, this is actually the most common method because it ties perfectly back to the financial statements, but it creates a really, really dangerous illusion. And that illusion is what we call the mechanical increase. Exam alert right here, folks. Listen to this. If a manager does absolutely nothing to improve their operations, like literally zero operational improvements, their ROI will still automatically go up every single year under net book value. Why? Because the denominator, the base, is constantly shrinking due to depreciation. It's a massive trap. It actually encourages managers to hoard old, inefficient machines just to inflate their performance scores and protect their bonuses, instead of actually investing in better, modern technology.
All right, moving right along to pillar number 2, measurement, looking at historical cost versus current value.
So most companies use historical cost, which is exactly what we just looked at. It's objective, it's highly reliable, and honestly, it's super easy to just pull right off the books. But here's the kicker. It completely ignores inflation. It actually makes divisions running on incredibly old, cheap assets look way more profitable than divisions that just invested in brand new, expensive, highly efficient assets. Because of that exact issue, the CMA syllabus really wants you to understand current value, which is essentially the replacement cost. Current value is so much fairer for comparing different divisions because it looks at what the assets are actually worth today. The catch, though? Well, it is highly subjective, it's pretty tough to calculate, and you better believe it causes a ton of arguments and probably a few thrown staplers between division managers and corporate headquarters. Next up is our third pillar, asset inclusion, and the crucial controllability rule. This brings up a super practical question. Should we just take every single asset listed on a balance sheet and blindly throw it into a manager's investment base? The answer is a resounding no, not necessarily. There are some incredibly tricky assets you really have to watch out for. Take idle assets, for example. What if a manager has a factory just sitting there entirely empty, but headquarters absolutely refuses to let them sell it? Should that empty building drag down their personal ROI? No way. Or what about leased assets? Under modern accounting rules, most of those leases are right there on the balance sheet now, which bumps up the investment base and drags down the ROI. This, by the way, is exactly why managers used to love off-balance sheet financing. And finally, allocated corporate assets. Imagine if headquarters arbitrarily allocates a portion of the shiny corporate jet to a regional manager who has never even set foot in it. That unfairly inflates their base and completely ruins their metrics. So, how do we solve this? We rely on what the source material beautifully calls Clare's rule. You just ask yourself one simple question. Is this asset controllable by the manager?
Guys, this is the absolute golden rule of responsibility accounting. If the manager cannot control the asset, you absolutely cannot charge them for it in their investment base. It really is that simple. If they can't control it, exclude it.
And that brings us to our fourth and final technical pillar, timing. Specifically, average versus year-end balances. This rule acts as your ultimate defense against sneaky managerial behavior. Picture a manager whose annual bonus depends entirely on their December 31st ROI. If a company strictly uses year-end assets for the denominator, what is stopping that manager from engaging in a little window dressing? Basically, they could fire sell a bunch of heavy equipment on December 30th. Their investment base plummets for exactly one day, which artificially skyrockets their ROI on the December 31st report, and boom, they look like an absolute genius. It is a huge trap. So how do we fix it? Well, here is your mathematical solution: average invested capital. You simply take the beginning assets, add the ending assets, and divide by 2. Now listen closely to me, because here is another major exam alert. When you're sitting there for the exam reading a prompt, if they give you 2 years of balance sheet data, that is a giant flashing neon hint. They are actively testing to see if you remember to average those numbers together to prevent window dressing. Do not fall for that year-end trap.
All right, let's bring it all together now in our summary, the investment base matrix.
Get ready to take a mental screenshot here, because this matrix is the ultimate study guide for this topic. Let's do a quick review of exactly how each accounting choice directly drives real-world manager behavior. If you use net book value, that's cost minus depreciation, the ROI increases naturally over time. And the incentive? The manager just hoards old, fully depreciated assets. If you switch over to gross book value, the original cost, the ROI stays nice and stable. The incentive changes entirely. Now the manager is willing to invest in new assets without taking an immediate penalty to their ROI from a suddenly massive new asset base. And finally, current value, the replacement cost, means the ROI is going to fluctuate with the market, but it crucially incentivizes managers to focus on true modern efficiency. Understanding the how and the why behind these numbers, that is exactly what separates a mere bookkeeper from a certified management accountant.
All right, you've got the nuances down now, so let's end this explainer with an empowering logic check to test your true mastery. Think about this carefully. If a company switches from net book value to gross book value for calculating ROI, will the reported ROI for a division with very old equipment likely increase or decrease? I really want you to chew on that. Just think about how that denominator changes when we stop subtracting all those years of accumulated depreciation. Keep studying hard, trust the process, and I will see you in the next explainer.